Hello everyone, welcome to our new video. We continue with chapter 3 in our finance module. So we will talk about the income statement in this part. A typical stockholder focuses on the reported earnings per share, but professional security analysts and managers differentiate between operating and non-operating income. So operating income, this is derived from the firm's regular core business. In our example, company Allieds, they are producing and selling food products for this example. And it is calculated before deducting interest expenses and taxes, which are considered to be non-operating costs. Operating income is also called as EBIT, EBIT, or earnings before interest and taxes. So operating income, or so-called EBIT here, is given by the difference of sales revenues minus operating costs. So by looking to this number, we can understand over the accounting periods, we can understand how the company is doing in its main core business. And for our example, this is given as 3 billion, this is in millions of dollars, so this is $3 billion minus the operating costs. That gives us the operating income around 283 million USD. Here's an example of income statement for our Allieds Corporation. And we can see that there is net sales. And we have operating costs except depreciation and amortization. That is also given as basically 2.6 billion USD. And then there is the item for depreciation, amortization, given as 100 million. So by adding these two items here, we obtain the total cost, the total operating cost. And that's given by this number here. So from the net sales, we subtract these costs, and then we obtain the so-called operating income, or earnings before interest and taxes, known as EBIT. And then from this number, we can deduct actually the interest payments, and that is given as another 88 million USD. So if this is subtracted from this number here, 283 minus 88, and then we obtain earnings before taxes, which is denoted by EBT. And then the tax will also be paid, of course, by the company, and that is also deducted. And here it is 40% of this earnings before taxes, and given by 78.3 million USD. And once we also subtract this number from the previous EBT figure, we get this net income here. And as you see, this is given in this example for 2014, and basically the company's net income actually decreased a little bit. And if we look at to the operating income of the company, actually the operating income, the main core business, the company is actually doing better than the last year. However, as we see, there is an increase in the interest expenses from 60 to 88. So this is causing a decrease in the net income of this company. Okay, and then some basically there might be some dividend payments of this company, and once the dividends are also paid from the net income, so actually if you subtract this 57.5 from 117.5, then we will obtain this number here, 60 million, as the additional retained earnings, because the company generates some net income, and the company can pay some dividends, but after the dividends are deducted, the remaining part is retained earnings that will add on the equity of the company in the balance sheet as well. Okay, so some per share data is also demonstrated here for our company, here given as, for example, earnings per share. And remember, this corporation had 50 million shares. And basically, the net income can be divided by the number of shares in order to calculate the EPS number. And then there is also the dividends per share. And remember, the dividends is given by this number. So if we divide this 57.5 by 50 million, then we get per share, the dividend per share is given by 1.15 USD. And then the book value per share can also be written by dividing the, well, we have already calculated this in our previous video. This was coming from the balance sheet, okay? And there are some notes here. These notes are about the calculation of these ratios that are presented. So notice that this Allied Corporation has 50 million shares of common stocks outstanding. And based on net income available to common stockholders, the earnings per share number is calculated. So calculations of earnings per share, dividend per share, and book value per share for 2014 are given as a result of these calculations. So first of all, how do we calculate the earnings per share? Basically, for this example, we have the net income of the company, which is actually 117.5. This is in terms of millions of USD. Therefore, we get 117.5 million US dollars as the net income, and then divided by 50 million shares. Okay, so this gives us 2.35 as the earning per share. The second quantity, dividends per share, denoted as DPS. So how is this calculated? It's simple. The total amount that is paid as dividends, okay, this is the total amount, 57.5 million US dollars. And we divide it simply by the common shares outstanding, which is 50 million, and we get 1.15 as the dividends per share. And another one we have is the book value per share. But remember, we have actually demonstrated this from our balance sheet, where we have the total common equity, and we divide this by the common shares outstanding. And that was already calculated in the previous video as $18.8. Okay, we have a few more notes here regarding these important concepts that we have been using. One of them, as you notice, is depreciation. This is the charge to reflect the cost of assets depleted in the production process. Depreciation is not a cash outlay. Basically, we have these assets and they are depleted during the regular production process. So we need to basically discount that part. Okay, we need to add that cost on our statements, on our financial statements. And then there is a so-called amortization, a non-cash charge similar to depreciation, except that it represents a decline in value of intangible assets. Here, as you see, the keyword that we need to keep in mind is the intangible assets. So if it's a tangible asset, such as you might have a vehicle or some equipment that has a certain life expectancy, then every year we will deduct some percentage of the value as depreciation. But for intangible assets, that's the amortization. We have already explained what is EBITDA. Basically, we have the previous definition for EBIT, as you have noticed here, earnings before interest and taxes is called as EBIT. And then here we have earnings before interest, taxes, depreciation, and amortization. That's called as EBITDA, EBITDA. Okay, the next part is about the statement of cash flows, but let's stop here and we will continue in the next video. Thank you very much.